Though international investors are interested in engaging because we've got a ridiculous pension policy in this country where pension funds own less than 2% of the stock market. I think all those things, Stephen. Number three, we don't really have the kind of growth stocks that at the moment is where the momentum and the force is, and that hasn't changed. And it also depends on your style. I mean, I mentioned that the UK is cheap in aggregate. That's a lot of the things away from the top 10, a lot of which are very staid and dull. Stocks really, and Shell, BP, dependent on the oil price. There's a lot of noise below, and I'm only reflecting the conversations I have with the fund managers, which I've done for 30 years, and they're genuinely excited. They can see a lot of opportunity. It won't be realised necessarily today, but it is cheap. But the momentum is with other parts of the market. You saw what can happen if that goes wrong last night with ASML, but it is not there yet. But my job is to look at long-term value and to look at where the trade is today, and those two are distinctly different at the moment. The momentum is with the US. Honestly, GEMS, Japan, UK, where the value is.
Let me stick with the UK one more time before I'm sure Karen will broaden it out, Peter. I genuinely think this is the most interesting, arguably exciting budget. I could probably go back to 1997 when you and I were young men, Peter.
Really?
I think arguably, I say arguably the most exciting since Gordon Brown's first budget as well.
We were young men.
Well, we were young men then. We were in our 20s, I believe. What do you think? I mean, it's a big one from her as well about whether those pension fund managers and others should get excited about UK.
No, I mean, I think it's a genuine attempt to try and move on from the relative chaos of the last administration because it was in its dying embers. It doesn't matter whether that was blue or red. It was 14 years on. It was too long. I think it's a genuine attempt, but I do think they are hoon of the share the pie, don't grow the pie. They're going to talk one thing and do something else. There's 40 billion, which is muted, which is quite possibly what she's going to look to raise. I mean, you can do that by changing the debt ceilings. There's all sorts of ways in which it can be done. And there will be elements of, I think, go for the broadest shoulders brigade, which is fine, but it doesn't really solve the fundamental problem, which is we have a productivity problem in this country. And that's not going to be resolved by taxing the wealthy more or indeed taxing employers more. And you need to get to fundamental root and branch of what the problem is. Poor infrastructure planning, appalling actually in so many ways. Lacks regulation. Look at the water companies for effect. Monopolising water companies is always insane. And those are the things we have a problem with. It's ultimately productivity. It's not resolved by taxing people more.
Peter, let me get some market trades elsewhere across Europe because the French stock market again under pressure. It felt as though the China stimulus floated the boat of a lot of China proxies, and the French market was one of them with the big name luxury stocks. But the wake-up call today is that, look, the China consumer isn't spending. Maybe happen down the track, but in the hard and fast numbers we've got now, there is no appetite. So the stock market again in retreat. What do you make of the prospects of the French market from here on in?
France or China, I'll do both if you wish. France is really challenged. I don't care what anyone says, that political situation is very, very challenging. And it is causing undue pressure. Look at France versus rest of the world. France is materially underperforming. Rest of Europe is materially underperforming, which is a shame because there's so many fantastic companies in there. But again, the French are adopting the let's soak the rich, share the pie, don't grow the pie. And it's that social democratic model which has dominated Europe for 30 years, and it's coming back to bite. Sorry, end of story. It is the problem. It's the same malaise that exists in the UK. It's a productivity problem as much as anything else. They're more productive than we are, but they are challenged. And Germany is seriously challenged. Its industrial model is right under the microscope, and the likes of China are eating its breakfast, lunch, and dinner. So it is a real problem, and it needs a wholesale rethink. And just chucking more money at it is not going to actually resolve the issue. It's been the response since the GFC, but it's coming home to roost, both here and in Europe.